And it's a pleasure to welcome Simge Ulucam of BlackRock, who's presenting the inherent complexity of ESG investing. This is joint with Jeff Bond and Lisa Goldberg. Simge, please go ahead.
Thank you, Robert, for that introduction. And hi, everyone. WMO, World Meteorological Organization, estimates that the Earth's surface is now over 1.1 degrees Celsius warmer than it was before the steam engine was invented. On our current climate trajectory, which is a 3 degrees hotter world than pre-industrial levels, coral reefs are predicted to completely disappear. Arctic ice is expected to completely melt in the summers, and the Amazon rainforest is not expected to survive. Weather extremes are fueled by the rise of emissions of human-made atmospheric carbon dioxide. The damages are man-made, and the cure will have to be as well. And we're already on a roll. In the last decade, we saw a substantial increase in our awareness of our impact on the planet and our awareness towards society and our basic human rights. Climate action, net zero emissions, carbon neutral economies, population growth, overconsumption are prominent themes in our daily lives, as well as pro-life, religious values, social justice, women's rights, equal pay, corporate transparency, and fairness. With all this increase in demand and awareness, we saw a prevailing mood of philanthropy among businesses. Businesses started investing in the public good and focusing on the quality of life. They've also been investing in sustainability through research and innovation. ESG, environmental, social, and corporate governance, measures elements related to sustainability and the social impact of a company. It's now acknowledged that a company's value includes intangible assets related to ESG. And many investors have shifted their asset allocations to account for ESG issues. At the same time, asset managers have been actively launching a range of innovative ESG products. According to Morningstar, ESG funds captured over $51 billion of net new money from investors in 2020 alone, more than double the prior year. So ESG is an investment innovation with increasingly widespread adoption. But as an investor, how do you really invest in ESG, and which product is the right one? To start with, the investor decides that she wants to incorporate ESG into her portfolio, whether she believes there's alpha in it or it's a reflection of her values, regardless of any pecuniary advantages. But how does she go about actually investing in ESG with all the different themes and metrics out there and the different implementation methodologies? As you'll see shortly, the answer to that question is inherently complex. This presentation is based on a white paper by CDAR co-director Lisa Goldberg, professor of the practice of economics at Cal and director of research at the Perio Group. Our co-author, Dr. Jeffrey Bond of One Concern, and myself, quant researcher at the Perio Group / BlackRock, and was presented at the Journal of Investment Management Spring 2021 conference by Dr. Goldberg. In the paper, we focused on several practical challenges that face an ESG investor, and the challenges of integrating ESG themes and data into the investment management process. Please feel free to jump in with any questions you might have at any time. First, let's start with this question. Is the civilization we built for ourselves really compatible with Earth's biodiversity? Can we meet our present needs without compromising the survival of future generations? There is no doubt we're facing an existential crisis, but there seems to be some disagreement on the type of action and the amount of action needed. There's a lot of denial as well. Also, why is it so hard to agree on a theme? Investment options related to ESG are numerous: racial justice, green energy, religious values, gender gap, the list goes on. There's a product out there for every theme. The choice of an ESG theme is a personal one. ESG metrics are non-financial in nature and are not part of mandatory financial reporting as of yet. Although SEC is now pursuing disclosure requirements around ESG reporting. It will do so to further its mission to protect investors and promote fair and efficient markets. However, as we all know, SEC's rule writing is slow by design. And the problem with voluntary disclosures is that companies can set their own standards. Lack of standardized ESG metrics creates opportunities for greenwashing by companies that are less interested in pursuing legitimate ESG objectives, but trying to get by meeting minimum criteria for a metric that can be easily gamed. Several institutions such as SASB, the Sustainability Accounting Standards Board, are working to form standards and define materiality to facilitate incorporation of ESG factors into the investment process. However, not all issues affect companies the same way. Paper recycling, for example, can be important for a print media company, while pesticide use will be on the top of the list for farmers. SASB identifies financially material issues, the ones that are likely to impact the financial condition of a company and therefore should be most relevant to investors. Furthermore, in 2016, governments committed a landmark agreement called Paris Climate Accord. It aims to lower carbon emissions and slow down global warming. Countries will report estimates of their carbon emissions and their strategies for lowering their emission levels. However, it is highly subjective how much curbing is needed and how to measure the effectiveness of their transition efforts. Our research highlights the importance of data collection, data curation, as well as transparency and customization on the portfolio construction side. There are countless ways to construct an ESG portfolio, resulting in a wide range of returns. What we measure and how we measure it matters, and that's the main focus of our paper. Same thing is true for style investing, for example. One can build a value portfolio in many different ways. It depends on how you define the value indicator. So let's assume we've decided on the issue area that's important to us. For example, carbon emissions. We want to help reduce our carbon footprint by investing in companies with low emission levels. Let's also assume there's a standard way of measuring this. So every ESG vendor scores companies the same way. How do we construct a portfolio using this score? And how does portfolio construction affect future performance? Also, what if we care about multiple things? Can we invest towards companies that care about women and gender equality that also have low emission levels? If yes, how do we combine these multiple factors into a single score or a single strategy? A typical approach to avoiding companies we don't want is to remove them completely from the portfolio. So this is done through exclusion portfolios. For example, we find the worst offenders in carbon emissions and just carve them out of the portfolio. Next, there's a choice on what to do with the remaining securities that are allowable in the portfolio. Do we cap weight them? So we proportionally blow up their weights to add up to 100%. So the final portfolio is still fully invested. Or do we reweight them and rearrange them in a way that best reduces risk? The second approach is the optimized approach, and it requires an optimizer and a risk model, because creating an exclusion portfolio with minimal tracking error to the benchmark becomes a complicated problem to solve by hand. Okay, here we start with an example where we carve out all companies from the GICS energy sector from a portfolio that tracks the MSCI ACWI index. This is a simple way of avoiding fossil fuel companies, which include oil producers such as Exxon, a major polluter, and oil drilling companies such as Schlumberger and Halliburton. And this is easy to do since we have sector membership data available as early as 1995. Next, we look at the performance of a simple exclusion portfolio versus the optimized portfolio. As mentioned before, the optimized strategy not only excludes the unwanted names, but also manages risk. By the way, we use MSCI Barra's optimizer, which performs a standard mean variance optimization. So each point in time on the plot shows the annualized active returns over the preceding 10 years. For example, when we look at year 2020, we see that both portfolios outperformed over the 10-year period through 2020. Excluding the energy sector was a good financial decision for that time period. 10 years ending in 2005 was a different story, however, as both portfolios underperformed because energy stocks were positive contributors to performance back then. Even though the same trend is observed in both portfolios over time, the performance of the two strategies are actually substantially different. As expected, the optimized portfolio hugs the benchmark more closely than the simple exclusion. The risk model has smoothed out the fluctuations experienced by the simple exclusion strategy. Any questions so far? Okay, prior to removing all companies in the GICS energy sector from their portfolios, investors may wish to know how big the sector is in the index. The total weight of energy in ACWI has changed over time, as we see with the green line in the figure. Back in 2007, ACWI comprised about 14% of energy companies, which went down to around 3% in 2020. It's due to the bad performance of this sector relative to other sectors within the index that pulled its weight down. We can also see this by looking at the performance of the simple exclusion strategy. With the blue line, it looks like the mirror image of the sector weight. And now turning to risk, here we show the evolution of tracking error for the simple and optimized energy exclusions. The rolling 3-year realized tracking error was uniformly higher for the simple exclusion strategy. The difference was largest during the great financial crisis, when tracking errors were generally elevated. ESG.
So can I ask you a question about that? If you go back to the previous slide. So tracking error is one measure of risk. What about realized volatility of the two strategies? Do you have any data on that? I mean, I presume the optimized portfolio is probably less volatile, but is that in fact correct?
Yeah, total volatility in the optimizer is not a constraint used. So we don't track the total volatility at all in this passive type of investment strategy.
Okay, so you're simply looking at tracking error. So so then a portfolio with a lower tracking error compared to the index could potentially be more volatile than one with a higher tracking error.
Correct.
So did you check what the realized volatility was?
Not really. We did not focus on that part. We're interested in relative performance and relative risk in this case, managing the index tracking portfolios.
Yeah. Okay. Thank you.
Sure. Okay, moving on to vice exclusions. ESG investing, as we know it today, has roots in employing vice exclusions, or sin stocks, as these are sometimes called. It was initially mostly faith-based and involved the avoidance of companies that generate profits from alcohol, tobacco, gaming, adult entertainment, and firearms. More recently, many secular investors followed suit, and new categories of vice has emerged, such as animal cruelty, oil, private prisons, processed foods, and sugar. As ESG investing gains traction, some vice companies, including big tobacco manufacturers, are now attempting to rebrand themselves as ESG exemplars. With tobacco being addictive and the single greatest cause of preventable death globally, this raises the question of whether they should be included in a portfolio from an ethical perspective. So in our example, we omitted the GICS chemicals and tobacco industries, as well as GICS brewers, distillers and vintners, casinos and gaming, packaged foods and meats, and soft drinks sub-industries from the MSCI ACWI index. These fall under consumer staples, consumer discretionary, and materials sectors. Here's a diagram showing the structure of one of the sectors with exclusions, the consumer staples sector. The excluded industries and sub-industries are marked here in orange. And most of the conclusions from this example are similar to the energy screening example we just saw. Optimized exclusions hug their benchmarks more closely than simple exclusions. Tracking error is regime dependent and is materially higher for simple exclusions than for optimized. So excluding objectionable categories from investment portfolios is also known as divesting. As we all know, divestment is a commonly used pressure tactic to achieve social goals, more recently adopted by some of the largest asset managers, including Vanguard, BlackRock, and Fidelity. However, divestment comes at a cost. Investors might miss out on some juicy returns of potentially profitable companies. It also introduces a large cap bias from cap weighting the remaining securities. Agricultural products, for example, a small sub-industry in the consumer staples sector, gets a tiny bump in its weight relative to the index from recap weighting. It's 2 basis points, whereas diversified banks get a much larger increase, 81 basis points, due to its size in the index. Every simple exclusion strategy carries a large cap bias, and the impact on each allowable security is proportional to its weight in the index. Interesting to note here is that the optimized active weights in the table don't resemble their simple counterparts at all. Agricultural products, a small sub-industry, has a 1.29% active weight in the optimized portfolio. And why is that? What distinguishes simple and optimized exclusions is how they manage unintended bets. Simple exclusion doesn't try to manage unintended bets, but the optimizer does. As it tries to lower tracking error, the optimizer can overweight securities that are correlated with the exclusions, leading to a correlation bias. In our example, the optimizer favored agricultural products as a good replacement. Correlation bias can be observed at the sector level as well. Active weights of large, non-excluded sectors such as financials and IT diminished with the optimizer trying to minimize risk. Which of these portfolios is aligned better with the investor's objectives? They both are, and yet they are very different from each other. And in most cases, investors aren't even aware of these trade-offs. So moving on to the next section, Another highly popular topic, gender diversity. Here we looked at the representation of women on corporate boards. In the energy example we saw before, we were lucky enough to have a long history of data. However, this isn't true for most of our ESG data. So instead we look at shorter time windows. From the perspective of an investor who prefers companies with gender diverse boards of directors, we looked at the performance of a simple and an optimized strategy that excluded any company whose board was less than 30% female. 30% is kind of an arbitrary threshold, but it's a number that one can reasonably expect companies to meet. In 2020, however, 52% of the index by count and 47% by weight didn't actually meet that threshold. Again, we looked at the performance of the two strategies. Here we show it for 2020. Both underperformed. Simple was worse than optimized over this time period. And this begs the question, where did this underperformance come from? To see that, we ran a performance attribution analysis. The underperformance of these strategies was mainly driven by the exclusion of a few stocks, including Apple and Tesla, which had excellent returns in 2020. Performance was confounded by technology stocks during this time period. It's also important here to mention that had we picked a period after 2020, we could have gotten an entirely different portfolio, because in January 2021, Apple added a female director to its board. With that addition, Apple would have made the cut and wouldn't be kicked out of the portfolio, which makes a difference from a portfolio construction standpoint because it's the largest name in the index. And here's a sector-based view of our gender exclusion strategies. The IT sector did well in 2020, but it was underweight in both portfolios, which contributed to their underperformance. Active weights were muted in the optimized exclusion, as was its total underperformance. Our final example for today is based on the MSCI ESG score. ESG scores can be obtained from many providers, and they represent a combination of the three pillars, E, S, and G. Again, different implementations of the score can lead to different portfolios, which in turn can lead to different risk and return realizations. This time, we built 3 different portfolios, 2 of them from our earlier approaches for exclusions, Simple and Optimized, where we carved out the bottom 70% of companies in our ESG rankings from the MSCI ACWI index. In addition to the Simple and Optimized exclusion portfolios, in practice, it's commonplace to create portfolios using tilts by tilting away from the benchmark when scores are available for securities in the benchmark. For example, an investor may ask for a minimum tracking error portfolio with a higher total ESG score than the benchmarks. So for our third strategy, we use the tilt, where we minimize tracking error while achieving the same overall score as the optimized exclusion. And this is the portfolio that's tilted on its axis in the picture. The third strategy is not an exclusion, so it doesn't force out the unwanted names as the other 2 strategies do. It is less constrained in a sense. However, all of these are acceptable approaches, reflecting the same client values in a different way. Looking at the performance of these 3 different portfolio construction methods in 2020, as we can see, again, there's a range of realized performance for the year. Consistent with its construction principles, the tilted optimized portfolio hugged the benchmark more closely than the other 2 strategies. We can also see this by comparing their forecast tracking errors. The simple exclusion portfolio, which doesn't require an optimizer to construct, has the highest tracking error in blue. Its optimized counterpart, the orange line, controls risk better, and the same ESG score can be achieved through a tilted portfolio much more easily, which is the gray line. As we can see, the risk profiles of these three portfolios are also very different. In our previous example, we looked at the portfolio construction using ESG data from a single vendor, MSCI ESG research. An added complexity comes from disagreements in ESG scores across different data providers, based on what is measured and how it's measured, and how scores from different issue areas are aggregated into a final score. We explore this by constructing a family of ESG scores from the E, S, and G pillars. We varied the weights of each pillar between 0% and 100% in increments of 10%. So we got several ESG scores from the different weight combinations. Then we constructed portfolios using these different scores. All optimizations were set to a target score of 1.3 times the benchmark. We looked at how different these portfolios were from each other. We measured this by their tracking error to a baseline portfolio that is created by simply averaging the three pillar scores. The industry standard for using tracking error is typically against the benchmark index. However, here we use tracking error as a metric for defining distances between portfolios. You can see in the histogram of tracking errors that the distances between portfolios mostly range from 0.5% to 1.10%. For some portfolios, it even exceeds that. And by looking at this, we can see that how data is combined matters. These portfolios are not the same. If the past is an indication of the future, we believe businesses may continue to operate as usual, as long as they can make money and raise money, and as long as it is allowed, even at the expense of public good and the quality of life. ESG is an area where our long-term and short-term incentives certainly do not align. When it comes to the environment, Morgan Stanley estimates that preventing climate change will cost $50 trillion, close to half of the world's annual economic output. And we all share in that responsibility. In this study, we aim to highlight several points. A practical strategy implementation can be complicated by different ESG objectives from investors, different portfolio construction methodologies, inconsistent ESG analytics and aggregation methods. We show that simple exclusions exhibit a large cap bias, which can be mitigated through optimization at the expense of introducing a correlation bias. As shown in our exclusion strategy examples, removing a whole sector from a portfolio can lead to unintended overweights within the other sectors. Optimized strategies can mitigate the unwanted exposures by minimizing tracking error. However, unintended bets may still appear, as there's a limit to how low tracking error can go within a given investment opportunity set. Even for index tracking portfolios, there are lots of different construction methodologies in use. Do investors understand the implications of choosing one over the other? So as we wrap up today, it's obvious to us that a simple application of ESG ratings to build portfolios can be much more complicated than it appears. We should always strive for transparency and make sure we understand an ESG portfolio's risk profile, regardless of the objectives that were used to construct that portfolio. I think you're on mute.
Yeah. Are you pausing for questions now?
Yes, please
Okay.
go ahead.
So
Go ahead. I'm sorry.
No,
Oh, I was
go
going
ahead.
to ask Simge, so risk models identify correlations among securities, and that's part of what's used in optimization. So when you exclude things, it's obviously going to try to hedge those exclusions with correlated stocks. Have you noticed that does if you do that, if you hedge with similar stocks, do you notice, does that undo some of the ESG that you've tried to, in some sense, is it arbitraging the ESG factor?
Yep, in some cases, there's a cancellation effect. Some cases, reinforcement effect. It varies on the example we looked at. So when it's trying to lower the tracking error, in our example here, it loads on agricultural products, for example. And we believe this could be due to several things. First of all, agricultural products as a standalone sub-industry can be contributing minimally to the total tracking error. So its volatility is small. Or its correlation effect to the overall portfolio has some cancellation effects, or it doesn't contribute as much compared to diversified banks in this case.
Got you. Thank you. No, that's helpful.
Of course. Any other questions?
So I have a question. So the slide you have up right now says simple exclusions carry a large cap bias. And I understand that comes from the formula near the bottom of the page, but I guess I'm focusing on the question of what bias means. So, I mean, suppose I excluded the 500 largest stocks by market cap. So that's roughly speaking the S&P 500. It's probably not exactly. Then I'd have an index of mid and small cap stocks, and it's a little strange to say that carries a large cap bias, because in fact it's excluding the large cap stocks. So I guess I'm not sure that I agree with the wording in the title of the slide.
Right, it's a bit confusing. So in a cap weighted, I guess, strategy, what it means is if a security is already large in the index, its cap weight is big, then the impact of blowing it up is going to be larger.
Yeah. Okay, so the next question is, suppose you started with not a cap-weighted benchmark, but an equally weighted benchmark, and then you did an exclusion and then chose to increase the weights proportionally, but if you started with an equally weighted portfolio and increased weights proportionally, then they'd still be equally weighted. So this phenomenon starts if you do a simple exclusion on a cap-weighted
correct
index. Okay.
It only affects those. Yep.
Are there other questions?
Yes, I have one. Is it fair to say that the effect of the optimizer is to find assets that have the same performance characteristics as the bad assets, the ones with low ESG scores or that would be excluded, and overweight those, in effect finding good assets with the same underlying factor exposures as the bad assets and overweighting the former and underweighting or excluding the latter?
Exactly. So it's looking for a good replacement with the same risk characteristics. And it's all quantitative based, so it doesn't have to justify in a qualitative way why it's doing things. So it's numbers based. as long as it can match the risk profile and meet all the constraints used in the optimization.
Thank you.
Of course.
Are there any other questions?
Hi. I just would like to know the optimization, does it actually use a fixed window or a slide-in window? How actually that the optimization is performed?
Yep, great question. So in this case, we use monthly rebalances to meet our targets, but you can use a different rebalance schedule. You could do quarterly or even intra-month.
Okay, thank you.
And so the example of Apple, so you said that at some point in the data period, it would no longer be excluded. So did you, oh, you only had ESG data from 2020, that's right. So you took those ratings in 2020 and applied them to your whole data period. Is that correct?
Yep, that's correct. And
Okay.
all of 2020, it stayed below the threshold of 30%. I believe they had two female directors out of 8, and then they added one more person, if I don't remember incorrectly. 3 out of 9 it became, and started meeting the threshold, which is too sensitive to a single security in a cap weighted index, with Apple being the largest name.
Right. But in general, you took your ESG ratings for 2020 and then applied them to choose the exclusions of the portfolio all the way back through the data period. Is that right?
Correct. We only looked at the year 2020 with static data end of 2020.
Okay, because the ratings were either didn't exist at all early in the period, or they covered relatively few companies, and more have been covered as time passed. Is that's correct?
Yep. So resources are limited when it comes to ESG data, we found. So if you want to do like historical back tests, it's really hard to come by good ESG data. So even when we're doing back tests, we try to limit them to less than 3 years time periods. And if we don't have access to any earlier data points, we use current data and apply it historically, which is not ideal, but that's all we have.
Yeah. Okay. Any final questions? Okay. Well, thank you very much, Simge. This was a very interesting talk. Enjoyed it very much. So we'll continue next week, and